Technology. First, I regret that I'm unable to be there in person, but I'm grateful for the opportunity to zoom into your meetings and to introduce the next two speakers. Between them, they have a wealth of knowledge to share with you, so let me briefly introduce them, and then I'll be back to ask them a few questions after Allison's presentation. Dr. Rob Johansson is Director of Economics and Policy Analysis at the American Sugar Alliance and is celebrating the one-year anniversary of his joining the sugar team. Rob analyzes and interprets market dynamics for the industry and keeps us up to date on how the market and government policies can affect U.S. sugar producers. Prior to joining the Alliance, he was the chief economist at USDA, where he directed commodity analysis, headed the risk management agency, and managed the designs of various USDA programs. In addition, Rob's work experience with the Congressional Budget Office and the Office of Management and Budgeting are invaluable to our efforts to help shape legislation and policies that benefit our growers.
As Jack mentioned, I've been with the Sugar Alliance now for 1 year, which is important for a number of reasons, but certainly one of the things that the 1 year period allows me to do now is to go back to USDA, where I was for about 20 years, and I can talk to my colleagues about the sugar program, which I was prevented from doing for that 1 year period. So we'll talk a little bit more about that as we get into the slides. All right, I'm going to go to the next slide. Here we go. Just a quick intro about me. You may remember Jack Roney, my predecessor. He was very good in mentoring me and introducing me around the industry over the past year. Of course, that was a little difficult during COVID, but now I'm here. As I mentioned, it's good to meet everybody. Jack and I did share a couple similarities. We both enjoyed hockey. Here's a picture of me as a young lad up in Minnesota, where I grew up. We both enjoyed beverages. Jack enjoys those made by grapes, as you may recall, and I'm enjoying a grain-based beverage here on the ice in Minnesota. After my time in Minnesota, I served overseas with the Peace Corps for about 4 years in Central Africa, working with farmers. Came back to the U.S., got my graduate degree in agricultural economics, went off to Washington, D.C. to work with USDA, and that's where I settled with my wife and raised our children there in Northern Virginia. All right, the outline today that I'm going to talk a little bit about the macroeconomy, farm situation here in the U.S., sugar outlook, summarize a little bit. Hopefully Alice and I will complement each other's talks. She's going to dig a little bit more in depth, so I'm going to cover the top line notes. Generally, I usually start with talking about where economic growth is in the United States. We know that 2020 was a really tough year for the economy, bouncing back in 2021 and 2022, but then returning to more normal conditions in 2023. So again, as you all know, a fairly strong economy right now, a lot of economic growth, and that brings up this key risk to that growth is inflation. We've seen a lot of discussion about inflation. I'll talk a little bit about inflation here. Certainly something that our customers are talking about right now. They're seeing inflation in the grocery store as well as our industrial users are also talking about inflation in different ways. And of course, we try and couch sugar price inflation in ways that are understandable both to our customers at the grocery store as well as our industrial users. Consumer price index running at a 40-year high, just bouncing back from extremely relatively low levels of inflation last year, of course, with the pandemic, but still certainly something that the Federal Reserve is focusing on. Now, what's driving that inflation? Well, for the past year, we've been giving stimulus out to a lot of the economy, a lot of households, and that's translated into an increase in demand for a lot of consumer goods. Of course, a lot of Americans weren't spending money on entertainment, on travel, what have you, the last year. That money is building up their savings, but also building up their demand for durable goods. Stimulus also, of course, went to the ag sector. We saw a lot of support when I was at USDA. We were working on putting up the CFAP program, the Market Facilitation Program prior to that. In addition, the Small Business Administration had a program for a number of producers So overall, between 2021 and 2020 and 2021, we saw payments to U.S. farms at about $31 billion over those 2 years, and an additional 14.5 or so in non-USDA pandemic relief that went to the farm sector. So we did see not just U.S. households spending more, but we also saw producers spending a lot more last year. Tractor and combine sales up by double digits here relative to last year, just showing how those are running up 10% with tractor sales and 25% up from last year for combine sales. Contributing to this, demand, at the same time, we're seeing a lot of bottlenecks in the supply chain, mostly in transportation, whether that's deep sea freight, which affects certainly some of our shipments of sugar if we're importing. We're the number 3 largest sugar importing country. But also here in the U.S., of course, we've seen a lot of truck transport and a lot of rail transport inflation, both running at significantly higher levels than we've seen in the past. Energy costs also up. We're starting to see those level off a little bit. Diesel and gas at about $3.50 a gallon right now. Crude oil sitting at about $80 a barrel. Those are also going to be contributing to costs next year, and we'll see that in some of the numbers that USDA has been putting out in terms of what we can expect to see for inflated input costs next year. The Federal Reserve is certainly talking about raising interest rates to deal with this. You can see some of their notes from their open market committee meetings signaling that they're expected to raise interest rates this coming year of up to 75 basis points. So we'll see that will obviously increase the cost of borrowing money in the U.S. Loans will reflect that, and we'll see interest costs for farm balance sheets going up. So, what do we think about, what do consumers think about the economy, and similarly, what do producers think about the economy? I've got 2 indices here. One is called the Purdue CME index, that's in green. And the University of Michigan also does a survey of consumers. You may have heard of the Consumer Sentiment Index, that's in gray. Both of those started diverging from actual underlying fundamentals back in April, May, when inflation started taking off. So we've seen, I'm showing just corn prices here at index, very strong high prices for a lot of food commodities. Similarly, the Dow Jones has been going up relative to pre-pandemic times. But strangely, we've seen this divergence of how people feel about the economy occurring pretty much tied to when inflation started taking off. USDA just put out new numbers on farm expectations for 2022. We saw farm profits grow in 2021, but expected to come down about 2% on farm cash income, and net farm income down about 8% in 2022. And that's driven by a couple things. Mainly, even though crop value and livestock values are expected to go up this coming year, lower government payments as well as higher input costs are expected to bring that down, but still running at above 10-year averages in terms of net cash income and net farm income. Expenses up in 2021 by quite a bit across the board. I've got another slide here. I'll talk about this one a little bit more. So we've seen cash rent going up relative to 2020 to 2021, as well as from the last Farm Bill. So if we look back to the last Farm Bill at the end of 2018 till 2021, we're also seeing increases in these expenses. Cash labor is one of the largest, also storage and transportation costs going up significantly. As you all know, the cost of buying fertilizer is going up quite a bit as well. We're seeing year-over-year increases in anhydrous at about 195%, urea up 142% compared to last year, and phosphorus also up significantly. New report out by Texas A&M that I'm pointing to here that doesn't quite capture the most recent upticks in fertilizer prices, but certainly this is something that's weighing on a lot of producers' minds going into planting this spring. On the other hand, the balance sheet has been strengthening. I just want to make sure that I'm talking about the same slide that you guys are looking at. So we've seen an improvement in the balance sheet. We've seen the number of delinquent farm loans declining as tracked by the Kansas City Federal Reserve, and the percent of those also falling. So, generally speaking, farm loan delinquencies have been historically low over the past 10, 20 years. A lot of times when people start worrying about inflation or looking at debt levels going up. Everybody remembers back to the 80s. We're in a very different situation right now. The balance sheet is quite strong in terms of the farm balance sheet. That's being translated into higher cropland values, so I'm just showing across the board from Minnesota down to Texas. Don't have values for the southeast here. I do show some southeast values here also on the right-hand side. A little bit harder to track, but overall, farmland values on average going up by about 8% last year, but double-digit increases in the most recent quarter in a lot of non-irrigated cropland areas. So, looking at prices right now, why are they firming up? Well, we're seeing a significant dryness in South America. That's affecting a lot of their crop. Will be affecting their sugar production this year as well. So expect to see continued tight balance sheets, and we'll talk about that in a second. But overall, we're seeing in 2022 expectations for higher prices for most of the commodities that USDA puts out in their monthly WASD. Increases of corn, and it's sitting at $5.50 here for 2022. Obviously, cash price is a little bit higher than that right now. Soybeans at over $12 a bushel. USDA's forecast for overall net returns over variable costs over the next 10 years shows that 2021 is certainly expected to be a peak, and well, they do expect to see some declines over the next 10 years, still remaining relatively high compared to the historic average. So that being said, as you all know, 2021 is a good year. You're buying inputs at low prices and getting fairly good prices for your commodity. So one thing that I've been asked to look at is how do current market prices compare to farm loan rates across a couple different commodities. I'm showing cotton, corn, and wheat, refined sugar, and raw sugar here. So this is the loan rate divided by the price that you're getting. So the strength of some of the commodities such as corn is driving down that percent. So the loan rate relative to the market price is relatively low right now, just because we have high corn prices. Certainly we see a much stronger relationship between the loan rate for refined and raw sugar compared to the current market rates. And that's for a number of reasons, and we'll get to the prices right now and then get to the sugar outlook. Overall, world sugar looking like the balance sheet is tightening up a little bit. Over the last couple of years, we've seen this occur. Why is that? Well, overall, we see growing global demand for sugar at about 1% per year. This is data that Zarnico has just put up on their website. So over the past 10 years, that suggests that we should see about 14 million metric tons more of sugar consumed globally. Yet there has been very little investment in new expansion of either wheat or cane acreage globally. That's contributing to that tight stocks-to-use situation globally. And why is that important to domestic prices? Because of course we have the domestic sugar program that separates us a little bit from the global market, but we'll get to that when we talk a little bit more about the tier 2 levels of sugar imports. In the U.S., since 2000, sugar consumption has been growing at about 23% over that time period, but flat on a per capita basis. So Americans are generally consuming roughly the same amount per capita that they have been over the last 5 to 10 years. But still, as the population grows, we still see continued growth in overall sugar consumption in the U.S. At the same time, total sweetener use has fallen, and that's mostly because Americans are eating much less high fructose corn syrup. Production-wise, this year we're expected to see a record production of sugar, domestic sugar in the U.S. at 9.4 million short tons raw value. Part of that driven by the recent uptick in the crop here in Louisiana. The USDA just increased its estimate of sugar production from Louisiana in its last WASD. Overall, if you remember back in the summer, we were facing a fairly significant drought in the upper tier states, the beet states. So in addition, with Hurricane Ida, there was some worry that we were going to see a drop in sugar production. The drought in the upper Midwest cleared up right before the harvest. They got some timely rains, and certainly, as you all know, you had very decent conditions for harvest this year that increased sugar production. Overall, beet deliveries are up relative to well, this is the last year, but also this is showing the drop in beet sugar deliveries following the 2019 force majeure. Cane sugar picked up the slack that year. Things are more returning to more normal conditions where you have a little bit higher beet sugar deliveries. Overall, it's about 54%, 50% cane sugar, and between 46 and 50% beet sugar deliveries. Non-reporter deliveries increased a little bit as well in that year, but again, returning to more normal conditions as we move forward into the crop year, or into the 2022 season. Stocks to use ratios, as you know, following the 2017 suspension agreement revisions with Mexico, we've seen stocks to use ratios here in the United States sitting in that 13.5 to 15.5 target range by USDA. All right, just talking about prices a little bit. The current world raw sugar price at number 11 contract. It's a global price for raw sugar. We add to that about 3 cents for transportation. That's that purple line there, running below the U.S. raw number 16 price at about 36 cents a pound. I drew a line there to show the suspension agreement floor with Mexico between 25 and 26 cents. So right now, the number 16 domestic contract is running about 10 cents above that floor that's essentially guaranteed by the suspension agreements with Mexico. What does that mean for Tier 2 deliveries? So we've seen some Tier 2 sugar entering, raw sugar entering. There is a tariff that's paid on that sugar at about 15 cents a pound. So if you get a difference occurring between that world raw price plus transportation and the U.S. price that exceeds that 15 cents, you're likely to see more Tier 2 coming in. So right now we're right at that ceiling. As that global sugar price, as I was mentioning earlier, increases, that raises the ability for the domestic raw price to go up without triggering a Tier 2 entry. So it does provide a cap on our prices here in the U.S. As that level for world raws increases, we also see that cap increase. Looking at the refined price, we're sitting at about 39 cents a pound for refined wholesale beet sugar. That's about 5 cents above the suspension agreement floor at 33 to 34 cents. And again, above the world refined price. We're a little bit further away from that cap. So again, there's a 16-cent tariff on Tier 2 entries of refined sugar. We're a little bit further away from that at the moment, so less likely to see refined Tier 2 coming into the U.S. Okay, one thing we hear from our sugar users is that prices are running high, but when we look actually over time, we account for inflation. Real prices for sugar has been actually falling over the last 4 decades. Raw prices have fallen by about 34% over the last 40 years. Similarly, wholesale refined prices have fallen as well by about 35% over the last 40 years. Nominal sugar prices at retail, so at the retail level, is also relatively flat, down just a little bit. It's interesting to note that certainly 7 in 10 Americans would say that they prefer U.S. produced sugar, even if foreign produced sugar is less expensive. So it's important when we talk about sugar prices to over a time period, to keep in mind what inflation has been doing to that price. So overall, the real prices for the product has actually been flat or falling. I'll compare that a little bit to some of the sugar user prices for some of their products. For example, we know that consumer price that producers or that consumers see at the grocery store has been increasing over time, looking back to 2010 when retail and wholesale prices were roughly the same. The wholesale price has fallen since that time, so this gap that we're seeing between the retail and the wholesale, we see it in beef, we see it in other commodities, dairy as well. It's essentially this wedge that the retailers are taking essentially in selling that product in their operations. Since 2010, producer prices down, as I mentioned, about 34%, consumer prices up 12%. All the while, the sugar industry is providing this service of storing sugar. We see that, as the harvest moves forward, we produce more sugar. We're doing it right now. We see almost 3 million tons of sugar that we put under storage in February and March period, peak of our production. Certainly the beet guys are producing at the same time. And of course, you all are paying for that storage, and it's not being charged to the users. Recent study that we had worked with the University of Tennessee on to look at do sugar companies actually lower their prices when they receive lower sugar prices? Because a lot of times they'll say the high sugar prices are cutting into our profits and forcing us to offshore some of our manufacturing. Well, we looked at that to see if that's actually true, and it's not. When sugar prices fall, sugar companies don't change the prices for their product at all. This chart shows that to a certain degree, wholesale refined price in the U.S., as I mentioned earlier, falling a little bit since 2010, but at the same time, prices for ice cream, candy, bakery products, retail, of course, going up at the same time. So these are the kind of arguments we use to rebut some of those statements that we hear from some of our customers. Overall, this is returning to inflation since 1980. Refined sugar price up 40%. But when you compare that to the input costs that you guys are facing, whether it's fertilizers, gasoline, fuel, machinery, wages, those have been increasing by a much higher rate. So that margin that you're getting on each pound of sugar is getting squeezed. So it's another story that we'd like to point out to some of the folks on the Hill, as well as some of our critics in the sugar using company. With that, let me finish up. I appreciate you listening to all these numbers. It's sort of the economic situation that we're facing right now, and usually I like to end with a slide of me in a sugarcane field in Louisiana, and I'll be taking some of those over the next couple of days. But right now, this is just a picture flying into to New Orleans the other day, looking down at some of the barge traffic that's there. With that, let me turn it over to Allison. Thanks for your time and attention.